So I'm very confident, and I was before the confirmation that, we are in the next leg of a major bull market in the precious metals. Silver above 37 technically is very bullish, very strong, and silver could take off at any time. You never know if silver can fool the best of us as far as wanting it to do something that it not performing the way you expect. But nonetheless, I think the trend is very clear. So even though the summer doldrums are here, the white metals seem to be doing quite well. August is usually the weakest month for the metals, but overall, very bullish, very happy, very pleased. I think the markets are moving at a pace that causes excitement, but not so fast that people will have the fear of missing out and think that, it's only going to last another month or two, because that's not the case in my view. It's going to continue. There will be some very sharp corrections that will scare people, but nonetheless, the overall trend is pretty clear.
We're entering the next phase of a significant bull market in precious metals, especially silver, which is technically strong above $37. While silver can be unpredictable, the overall trend is upward. Despite the typical summer slowdown, especially in August, white metals are performing well. The current pace of the market is exciting but measured, reducing fear of missing out and suggesting the rally could last much longer. Though sharp corrections may occur and shake confidence, the broader bullish trend remains intact. Historical patterns suggest silver could reach $50 by year-end before a pullback to $39 to $41. Jordan, the Daily Gold. David Morgan, a well-known precious metals analyst, author, and founder of the Morgan Report, believes we are firmly in the next leg of a primary precious metals bull market, with silver showing strong technical signals above $37 and platinum outperforming all metals year to date. Silver mining stocks have shown awe-inspiring strength, outperforming even gold miners in recent weeks. The SILJ ETFMG Prime Junior Silver Miners ETF demonstrates this momentum with powerful upward moves following minimal consolidation periods. This sector leadership aligns perfectly with silver's technical breakout above $35, suggesting that market participants are positioning for higher silver prices ahead. The outperformance makes technical sense given silver's historical volatility. It typically moves more dramatically than gold in both directions, with mining stocks amplifying this effect. Investors should note that while this outperformance is bullish, it also indicates growing market optimism that should be monitored for signs of excessive speculation. David points out that the U.S. dollar is weakening and may fall to around 91 on the DXY index soon, driven in part by policy preferences for a cheaper dollar to boost exports. Silver and the U.S. dollar index, DXY, typically move opposite each other. When the dollar weakens, silver gains ground, and vice versa. Analysts highlight that a breakdown below 99 to 100 in the dollar index could signal a significant dollar downtrend, potentially boosting silver by 10 to 20% in the short term. Dollar rebounds, global growth slowdowns, and occasional supply shocks could interrupt silver's rally. Silver continues to benefit from a weakening dollar, with technical and fundamental triggers aligning for further gains. A sustained breakdown in the DXY could spark a sharp silver rally to $40 by the third quarter of 2025. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
We talked a while back about, the confirmation idea in the metals. In other words, you got to have confirmation of gold's move with the other metals. And we've had that now, especially platinum actually outperforming everybody year to date. So I'm very confident, and I was before the confirmation that, we are in the next leg of a major bull market in the precious metals. Silver above 37 technically is very bullish, very strong, and silver could take off at any time. You never know if silver can fool the best of us as far as wanting it to do something that it not performing the way you expect. But nonetheless, I think the trend is very clear. So even though the summer doldrums are here, the white metals seem to be doing quite well, as gold kind of just is going sideways more or less until we get through the $3,500 level. It's the Morgan rule, where we see it 3 days in a row above the breakout point on above average volume. Then I'd be convinced that we're on on our way for, further gains. So I still think we're going to go sideways in gold through the summer. August is usually the weakest month for the metals, but overall, very bullish, very happy, very pleased. I think the markets are moving at a pace that causes excitement, but not so fast that people will have the fear of missing out and think that, it's only going to last another month or two, because that's not the case in my view. It's going to continue. There will be some very sharp corrections that will scare people, but nonetheless, the overall trend is pretty clear. Yeah, it's the latter, Elijah. I mean, I've been studying markets, not just the precious metals market, but market theory. I'm not a big Elliott wave guy, but I've studied that, Gann theory, a lot of things. I used to trade futures for a living, so I have a good idea of a lot of technical indicators, and you really want the fundamentals. And the fundamentals of the Elliott wave theory is pretty much there's 5 waves. There's 1 up, 1 down. There's 1 up, 2 down, 3 up, 4 down, and 5. And the 5th leg up, or 3rd leg up, or the 5th wave is generally the biggest, and that's where the 90% of the move comes in the last 10% of the time. And that's true in real estate, it's true in the stock market, it's true in the tech bubble, true in almost all markets. It's not an exact science, it's an art form. But on that basis, I think that we're going to see the largest move could get a double from here. So you go from 3,000, you could do the breakout. The first breakout really was $2,000 gold. We just couldn't seem to get above that ceiling. And then finally we did. We got above 2,000, went to 3,500, pretty short order. So you could take that 2,000 and you could double or triple it. You could say 4 to 6,000. And in time frame, 90% and 10%. What does that mean? Well, we've had basically a 20-year bull market, maybe more than that. That'd be 2 or 3 years. I'm thinking about 3. We've already started it maybe 6 months ago. So again, it's not a perfect science. So my take is we're going to see the biggest moves ahead of us, meaning rapid appreciation within 2-3 years, and expectations probably in the $1,000 gold, meaning like 4, 5, 6. I don't think we're seeing 10, but people think we could get 20. I could make that argument. And then silver, I said 2003 we see triple digit silver, and I still believe that. As far as where will the gold silver ratio be at the top, you didn't ask that question, but I've been thinking about it a lot lately. And the gold silver ratio in this bull market so far had a day or two at 33 to 1. And I think we'll get back there or close to it. So 40 to 1. I'm not so sure that we'll get to 16 to 1 or 10 to 1 that I wrote about way back in 2002 or 3. It could. It really just depends on market sentiment more than anything else, where we go. So higher, yes. When? I'll be vague. 2 to 3 years. Prices, I'll be vague. Triple digit silver, and then multiple thousands. A lot of commentators, some Kitco, some on LinkedIn, and other places talk about, the tier 1 aspect of Basel III. And I think Basel III is kind of overblown. I go back to the old market adage, buying the rumor, selling the news. The rumor's been out for a very long time. Lots of commentary about it. And now the news is out there. It's an act. So these analysts argue that Basel III is a bookkeeping reform, not a catalyst for gold buying mandates. Gold price remains driven, and it's really not. So gold remains driven by liquidity, central bank buying, inflation, and macro factors. Those are the same drivers that were there before Basel III. The reform looks like it could be explosive to boost physical holdings by bank, but that's really uncertain. Really, it's reduced some of the trading desk and consolidated things, but I think it's a kind of a ho-hum at this point. I don't agree. Gold remains a tier 1 asset, which is bullish, not bearish. In effect, it's a gradual structural shift, not an overnight shock. Gold prices, again, remain tied to the gold liquidity, real yields, supply-demand fundamentals, and central banks. It's not a no-brainer, but it's certainly not, I think, needs to be as hyped up as some others have said.
Basel III's impact on gold is overblown. It is described as a bookkeeping reform rather than a game changer. While it was first marketed as potentially increasing physical gold demand, the actual impact has been negligible, with some trading desks being downsized or consolidated. Gold remains influenced by larger macroeconomic fundamentals, including liquidity, central bank purchases, inflation, and real yields, just as it was before the implementation of Basel III. Though gold's status as a Tier 1 asset is positive, the reform is a gradual structural shift rather than a dramatic event, and it should not be overstated. David Morgan focuses on how the U.S. stock market has been continuously propped up by interventions, such as the Plunge Protection Team, since the 1987 stock market crash, preventing significant corrections that would otherwise occur in a free market. This artificial assistance is motivated by the need to protect pension funds, insurance systems, and overall economic stability. While the stock market appears healthy on the surface, when priced in gold, it has been in decline since 2000. The speaker now considers the idea of a hyperinflationary environment where the market continues to rise nominally but loses actual value when a currency collapses, similar to historical examples such as those of Zimbabwe and Venezuela. Although he's not certain, he sees a growing risk that the U.S. stock market may become a distorted, inflation-driven bubble. Now, let's recall the interview.
Thought about again and again and again. So I was, a fairly young man when the crash of 1987 took place. And that was really scary. I mean, no one expected to see that kind of a down day in the stock market. And once that occurred, they formed the Working Group on Financial Markets, better known sarcastically as the Plunge Protection Team. And what the powers that be that united under the working group did was they bought futures on the exchange, on the futures exchange, or like the S&P 500. They leveraged the heck out of it. So that's where a little bit of money has a lot of power because it's so leveraged. And they went in and they bought futures and they were able to manipulate the market higher and overcome that really devastating, very scary market correction, which might have been needed in a real free market. But nonetheless, the Plunge Protection Team rescued the day. So pretty much what I've witnessed from that point till now is whenever there's the ability to see the market really make a rather significant correction, 20% or more, there's always somebody, something, the PPT to come in and basically rescue the market and not let it falter too much. And there's reasons for that. I mean, there's so much tied to the stock market and the insurance industry and pension plans and 401ks and private pension works. I mean, really, if you had a 1930 style stock market crash where it was over an extended period of time and really couldn't, get off the map for quite some time as a metaphor, that would be so devastating to not only the United States and all the entities I named, but on a global basis as well. So I think there's a lot of power and emphasis to continue to provide the stock market with whatever liquidity is needed to keep it at a rather high level. They may not continue to move it higher and higher in real terms, because if you look at the stock market in terms of the stock market priced in gold, it peaked in the year 2000. That's 25 years ago. And that's the basis of one of these books back here called The Invisible Crash. Gold is a constant. An ounce of gold is the same mass anywhere in the universe. It doesn't change. So if you use that as the constant, you plot the S&P 500 against it or the Dow, you'll find actually they've been in a downtrend against gold. So what does that mean? It means that possibly, Elijah, and I'll get to the point, because this is very important, something I really wouldn't have thought of up until about the last 2 years, that if we get into a hyperinflationary depression, we could see a high stock market, which has very, very little value because the currency is being destroyed at such a rapid rate. I mean, if you want to look at some really well-performing stock markets, one of the best ever was Zimbabwe after they revalued. Venezuela, the same thing. I'm not saying the U.S. stock market is going to do, but it does give me pause for concern that there's so much bias to keep it moving higher that we could inadvertently turn the stock market into something that is similar to a situation where you get into an inflationary environment where the stock market looks very good on numbers, but as far as protecting you from an inflationary blow-up, it doesn't really do it. It's better than the bank, but it may be better in real estate in some cases. But in those type of situations, and I'm not forecasting this, but I've thought about it, I never would have thought before that we would ever see anything in that manner in the U.S. stock, that it was just too much free market influence still in those markets that no one could really overcome it and provide a inflationary environment where it just keeps going up. I've changed my view. I am not 100% on that, but I give it like a fairly high percentage that could take place. There's a direct correlation between the sound money system, or what I call honest money, and the more decline in a fiat system. There's a direct correlation. So the more the money is debased, the more the moral structure of the society is debased. And this has been shown again and again and again. So really, the whole system is based on trust. I trust that, that 5 quote unquote dollars will buy me the coffee that I want at Starbucks, and you can still do that. It used to be, 1/5 that amount or whatever it is. So when people lose their ability to trust each other or trust the currency, which is where all commerce comes from, that means that their labor is being devalued. In other words, you can't say for the future an hour worth of your labor today will be the same as an hour labor 10 years from now, which is what money's supposed to do. It's supposed to give you a value system, perpetuates stored labor so that when you want to use it, you get the same return on it that you had when you performed whatever the task was. So a truly free society, that trust has to be, number one. And so when that's destroyed and when the whole system is manipulated through interest rates, markets are flooded with currency to keep the liquidity like we just discussed in the stock markets, and markets don't reward, savings and prudence, debt becomes addictive. And because we are addicted to debt in a debt-based system, you got to continue to add more and more to keep the whole thing going. The adage that many have used is appropriate. It's like giving someone of the drinking problem more and more to drink, or someone with drugs more and more drug. It doesn't solve the problem, and to get the same high, more and more is required. And this is what's happening in the fiat money system. More and more debt have to be created to keep the system just going. But in real terms, it's actually depreciating, as I said about the Dow in terms of gold. So it's insidious because most people don't really understand what's happening. All they know is it costs more. They're earning more. They maybe got a pretty good raise, but they go to the grocery store and fill up their car and pay for the insurance or healthcare or whatever it may be, and realize that raise really didn't help them very much. In fact, they feel like they're getting poorer. It just doesn't attack the wall. It attacks your freedom. When people can't save, they can't plan. And when they can't plan, they can't act independently. And that means they rely more and more on credit to make up to keep their lifestyle up. Or they go on government assistance, or they have someone, manage the instability for them if you're wealthy or whatever. It's dependency, and that's the opposite of liberty. You're dependent on borrowing more. You're dependent on maybe some government program. You're dependent on that second job or whatever. And so that breeds control, because my whole film on Silver Sunrise really talks about the power that the money powers have to control society. And that's the danger. History shows that when the money system collapses, the political fallout is rarely fall behind. So if we do have a true currency crisis, there will be a political crisis basically at the same. And this isn't alarmism. It's basically pattern recognition. This has happened again and again and again. As Ecclesiastes says, nothing new under the sun. What worried me from the beginning when I founded the Morgan Report was that never to my understanding has it ever happened at this scale. You could argue the Roman Empire was a world empire, which it was, but we have a very sophisticated global situation with 8 billion people. And if the dollar goes, what happens? Now, I really will reiterate that I don't think the dollar will get to that place. I think that a new system will be enacted where we quote unquote reset to the new system before we have that kind of a problem. Nonetheless, I don't rule it out. I do think that the powers that be, for the most part, so much hubris and so satisfied with their ability to control things that they don't even conceive of the idea that things could get out. I do hold that as a possibility, although it's a rather remote.
Silver is poised to lead the next leg of the precious metals bull market, bolstered by technical breakthroughs, ETF strength, and a falling U.S. currency. While dramatic corrections are likely, the overall trend remains bullish, with silver potentially reaching $50 by year-end. Meanwhile, structural developments such as Basel III appear to have less influence than previously assumed, and ongoing market manipulations raise fears about a potential inflation-driven stock market bubble. These macroeconomic and technical trends indicate that silver may continue to excel in a volatile financial climate. Could a severe drop in the U.S. dollar index below 91 drive silver's rise to $50 faster than anticipated? Are current increases in silver mining stocks a sign of long-term investor confidence or an early signal of speculative excess? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed.